welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, April 25th, 2023, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, as I look at futures, it does look like we're going to get off to a little bit of a red start this morning. Dow Jones futures currently down 115 points. S&P 500 futures down 20, NASDAQ futures down 55, and that's with roughly an hour and a half to go to the opening bell. Crude oil prices down about 73 cents a barrel. We're sitting right at $78 a barrel, and the 10-year Treasury yield down 6 basis points this morning, back down to 3.45%. Of course, we got that big support now down closer to 3.30%. We've got moving averages and overhead resistance up in the 360 to 370 area. So really, we're sitting right in the middle of that now, and we'll see which direction we head. But the short to intermediate term trend has been lower in the 10-year Treasury yield, but we still have that long-term uptrend that remains in play. And of course, whichever way the 10-year Treasury yield goes likely will influence that growth versus value relationship. Today's agenda, let's jump in and see what we're going to go over. I'm going to start off with the daily market recap. That's the way we always start the show off. Talking technically, chart of the day, industry groups. Going to give you some insight the way I would be looking at this earnings season and which industry groups we might want to favor as these reports come out. Then earnings spotlight, and we will wrap up with the 3 you must see. Let's go ahead and jump into the daily market recap, get this thing going. So what happened on Monday to open up this new week? Well, the Dow Jones Industrial Average finished up 0.2%, up 66 points. S&P 500 was up about 0.1%, 3.5 points. NASDAQ down about 0.3%. That was down 35 points. Notice we finished at 12,037, which is getting close to that 12,014 level. We had it intraday. We were below it intraday, but did manage to come back up and finish above it. Mid caps pretty flat on the day, gaining 2/3 of 1 point. Small caps also very flat, almost finishing squarely where it had closed on Friday of last week. Looking at the sectors, we had energy leading up 1.5%. Beautiful bounce right off of that 20-day moving average. Also some key support around 84.5. So really nice day on energy. Materials following suit off the 20-day moving average, rising about 2/3 of 1%. Healthcare up a little more than 0.5%. Utilities up 0.5%. But look at the leadership there on the rebound and yesterday's action. I mean, I know we're sideways consolidating, but that leadership was not really what you want to see when you're trying to make a big breakout through key resistance. Energy and materials, I consider those more neutral types of sectors. They tend to work in both bull markets and bear markets. They also can falter in both bull and bear markets. Healthcare and utilities definitely, though, more defensive. They tend to outperform when the market is weak. So anytime we see strength here, if the market's going down, strength in defensive stocks is kind of normal. If the market is going up, strength in these two can be a problem if it continues over a period of time. Every day, I mean, I try not to nitpick day to day, but you know, the big top that we had at the end of 2021, one of the telltale signs was the fact that December was a good month overall, and all 4 defensive groups led the action. Consumer discretionary, one of the key aggressive areas, was the worst performer during the month. Not only that, but consumer discretionary trailed consumer staples by 10 percentage points in December of 2021 as the market made that final push to the upside. So that's one of those things you want to look at. That's not something that I'm going to focus on too often, but when I see the market going up, and it's been going up for a period of time, and I'm starting to think, you know, we're getting a little toppy and I'm starting to show some signals, then I would be looking for defensive groups to start leading, because that to me is almost like the final straw. It's just money rotating. from the big Wall Street firms, from aggressive areas to more defensive areas, and that can be problematic. One day, like I said yesterday, I'm not overly concerned, and it wasn't like it was a huge day. We did lose ground on the NASDAQ, but still, this is not the kind of leadership we want to see. The group I'm showing here to the downside that had the worst day yesterday, technology. This is the sector I want to lead. So clearly things were tipped upside down a little bit on Monday, not a great day. And historically, yesterday is the worst day of the calendar month. And what do I mean by that? Well, it was the Monday after monthly options expired. Monthly options expired last Friday. The Monday after is historically the worst day. And I'm not just giving you my opinion. That is a fact. If you go back and you look at the S&P 500 since 1950, it goes up roughly 53% of the days. If we only look at all Mondays, that percentage drops to about 47%. And if we only look at the Monday that follows option expiration Friday, the S&P 500 has gained ground only 37% of those days. So just a little bit more than 1/3 of the time, meaning that it drops almost 2/3 of the time on the Mondays that follow option expiration. So actually, it wasn't a bad day when we consider it from that angle, because it normally is a bad day. We had weakness in the morning. I thought it might accelerate, and instead, we came roaring right back. Okay, let's move on to the 10-year Treasury yield. So this morning, as I mentioned, we are seeing the 10-year Treasury yield much lower. Currently, it's down 6.5 basis points. We're back to 3.45%. So at this point, the 10-year Treasury yield not being reflected, the current 10-year Treasury yield not reflected. This is yesterday's close. So we are down now into the mid 340s. Looks like we've rolled back over and gone back below the 20-day, but this we've been seeing over and over and over again. The moves below the 20-day, above the 20-day, below the 20-day, above, below, above, back below, testing, back above, now back below. This is what we talk about when we say a market that's not trending. That's what happens. Prices go up above moving averages. They come back down below moving averages. Moving averages serve as great support and or resistance during uptrends or downtrends. But when you have neither, this is more what we see, just price action going up above, up below, up above, below. So I can look at it and say, well, it looks technically like we're kind of leaning to the right. So off of the high in October, looks like maybe we've got a short to intermediate term downtrend, right? But if we stretch this chart out and we go out, the last few years, let's just do 5 years, it's kind of hard to say we're in a downtrend. I think we've got to go back down probably and break below that 330 level. And I mean, technically, really, it's this low because you've got higher high, higher low, higher high, higher low, higher high. I mean, even in the longer term scheme of things, I could say this is the higher high, this is the higher low, this is the higher high. And so we'd have to go all the way back down here to turn the corner. I don't think we're going back down to that level. I wouldn't be surprised, though, later this year, maybe into 2024, seeing the 10-year Treasury yield back to 2.5%. We're sitting at 3.5% right now. And I just say that because at this point, inflation expectations based on the 10-year Treasury yield, in my opinion, I don't think there are many expectations. You just can't convince me that investors are willing to take a 3.52 or this morning 3.45% 10-year Treasury yield if we're worried about 6% or higher inflation. That makes no sense whatsoever. So I think the signal that the 10-year Treasury yield's giving us is that inflation is not a problem. And it's really the 10-year Treasury yield is reflecting more about the potential for economic weakness, believing the Fed should probably start cutting rates. And that's why I believe the 10-year Treasury yield is going to end up going lower. Because if you don't worry about inflation, if inflation's not a problem and you're trying to get the economy to move higher, you're going to see a lot of buying of bonds, sending the yields lower. The Fed's going to begin lowering rates. You're going to try to spur the economy when you're no longer worried about inflation. And so that's what I think is coming. Whether or not it's later in 2023 or into 2024, I'm not certain. I think I'm probably maybe a little bit ahead of everyone else in terms of when I think the rates start coming back down. I think it'll be in the fourth quarter of this year. But, we got a lot more data to get through, and that's just really an educated guess. As far as economic reports go today, while we're looking at the 10-year Treasury yield, we will get the February Case-Shiller Home Price Index. That's expected to drop 0.3%. January fell 0.4%. So a little bit of improvement there. February FHFA House Price Index expected to drop 0.1%. January rose 0.2%, so a little bit more of a drop there. April consumer confidence, 104 is the estimate. March was 104.2, so a little drop there. And then March new home sales also expected to drop from the February 640,000 unit level down to 634,000. So we got not great economic reports expected today. We'll see how everything comes in relative to the estimate. I can say, though, the February Case-Shiller and the FHFA House Price Index, I mean, we're almost to May, and we're talking about February reports, these two February housing reports. I don't know that the market really cares too much about what's going on 2 or 3 months ago. Market likes to look forward. So I'm just not seeing that there's going to be a big reaction to those reports. Anyhow, let's move on. The S&P 500 still rallying back yesterday, closing in the upper half of the trading range, even on a historically bearish day. And all that is doing is just continuing to add to the AD line, going higher and higher and higher. I'm seeing accumulation. I'm seeing it in a number of different forms. I know there's a lot of bears out there, but that is one thing that's a check mark clearly in the bulls camp right now. This AD line needs to roll over in a big way for the stock market to go down. You can go back and look at any major secular bear market sell-off, and they're accompanied by big declines, generally, big declines in the AD line. If we have real, true distribution, it's going to show up in this AD line. We are going to see selling all day long. We're going to see big, big drops with filled red candles like we saw earlier in 2022, even through that late August and September period of 2022. So that's what I would kind of be watching for. Barring that, I mean, what we've been seeing is a lot more hollow action, where we've seen the movement to the upside from the open to the close. So I'm still viewing this AD line as a very bullish signal until it changes, or until the market shows me something different. I mean, we're trading right now above the 20, which is above the 50. The PPO is positive. All of these are positive signals for the market. There are also signals that we've seen previously that went back down. So I don't think we're completely out of the woods, but these are signs, at least, that are pointing to a stronger market ahead. NDX, I really don't have a whole lot to add. Again, pointed out in the past that the April highs are higher than the February highs. That is not the case on the S&P. So we are seeing relative strength in the NASDAQ 100. Still got that August high above. That's the one we're going to be trying to chase down. All right. Going to move on to the chart of the day. If getting a chart of the day is something that interests you, especially from our angle, the way we look at things at Earnings Beats, then I would invite you to go over to Earnings Beats, scroll down, and right in the middle of the page, you can sign up for our free Earnings Beats Digest newsletter. This is delivered to your inbox every Monday, Wednesday, and Friday in the mornings. Usually I try to get these out by about 8:30 in the morning, maybe an hour before the market opens. Name and email address, all it takes. No credit card required. You can unsubscribe at any time. Just put your name and email address in there. Hit that subscribe button. We'll get you started. Today's chart of the day, I want to just show you GM. So GM reported their earnings. We'll come back to this chart. Let's take a look at what's going on here. You can see this morning, GM reported they're getting a positive reaction this morning, up 2.3%. So back up over $35. But if we go back and we look at the chart I was just showing you, you can see GM, the AD line has turned up just recently, even though prices have been going down. Is that a positive sign? I don't know. Price action is my number one, and we've been going sideways for a while. Even the move up today, back up near 35 or just above 35, we could fail again at the 20-day moving average. This could be just a temporary bump to the upside with a move again back to the downside. The thing that's been bothering me with GM is that GM relative to the auto group was performing pretty good. Even though it was going down, it was outperforming the autos as a whole, and we were at a 52-week relative high. So even though autos were not performing well, GM was getting its more than its fair share of the money that was in the group. And so that was encouraging for the stock. But since then, and as the money started rotating back into autos, notice it was rotating away from GM and more back toward Tesla. And we haven't really seen a whole lot to convince me that this downtrend is over. Now, we are starting to turn up, and we'll see not how GM opens. We know how they're going to open, probably a little bit better than average. But where do we go from the open? Does GM get bought up? Do we see a gap up and then continued movement? Can we take out this high up around 36.75? Or is it just a gap up temporarily with another move lower, clearing this triple bottom? Depending on which way it goes after earnings is going to tell me a lot more than the actual report and the early morning gap to the upside. So got some work to do there to take a look at. All right, let's keep moving on. I wanted to go over industry groups. So one of the ways I follow industry groups, I have a chart list that has all 104 industry groups relative to the S&P 500 on it. Now, if I sort this by name, you'll see all of the technology industry groups are first. They all start with 001, XLK, and then I've got them numbered 1 through 8, with each of the industry groups relative to the S&P 500. All right. And then I go on to the consumer discretionary and so forth, all the way through all 11 sectors. From there, what I can do is I can look and see, okay, what worked yesterday? Look at the percentage change. Semiconductors. I don't know if you realized yesterday, semiconductors were the best performing group. Well, then let me take that back. That was a dollar change. I don't know why. There we go. I didn't have it all the way back down. So I wanted to sort it by percentage change, not this is a little bit better. So renewable energy was number 1. Here you can see semiconductors are actually number 3. So still pretty close to the top. But look at what was leading yesterday. This is interesting because I talked about the fact that we weren't really seeing much strength yesterday from a sector level standpoint in technology. And we were actually being led by energy and materials and so forth. And all right, I'm throwing myself way out of sorts here as I'm sitting here looking at this list. I know these are the lists for the year to date, and then I just looked up and saw year to date. Let's go back. Let's do a refresher here, and let's do end of day. All right, that's much, much better. Okay, now we get the action from yesterday. So just scrap everything I just said. Yesterday, we were seeing the strength from energy materials, and it is showing up as it should be on the industry group chart list. Just had myself confused there for a minute. So looking at this, I can quickly see on a relative basis which industry groups were the best groups yesterday. Not only yesterday, but let's say the last week. It was option expiration week. Home builders were the best performers last week. Then we had gambling stocks. Then we had trucking, non-durable household items. Then we had medical equipment, broadline retail, So we did see over the last week a little bit of action in some areas that maybe hadn't been doing as well. Some actually did continue to strengthen. Areas like home builders and gambling stocks, they've been strong and they continued to strengthen. But we can go back even further and look at that year to date. That's why I had it pulled up, because I wanted to look at the year to date chart and look to see what industry groups have been leading. Because as we go into the depths of earnings season, we should start to see earnings, solid earnings from the groups that have been performing the best. Wall Street's been placing bets on these groups over the last quarter. And so this is where I would expect to see some really good action. So let's just take a look at a few of these at the top. We've got renewable energy trending higher. We can see the big breakout early March, sideways action, holding the 50-day moving average up near that 20-day. I think this group looks pretty good. How about next group, internet? It's nice to see internet having a good start to the year after the horrible 2022 it had. So we're definitely trending higher off of the low in November. We can annotate, look at this a couple different ways. But I would say maybe that being a trend line to kind of keep an eye on to the downside. I mean, we had this double top here, gapped up, pulled back, reaction high, pulled back, reaction high, pulled back, and then breakout. So at this point, I would be looking at that maybe as a support area on any significant weakness. If all of a sudden the market did run into some troubles, I think that would be a key trend line to watch to the downside. But right now we're trending above the 20-day. As long as we hold the 20-day, I wouldn't be worried about the trend line or even the 50-day moving average. But if we fail and we have a meaningful decline, like a big red filled candle that takes out the 20-day, that's the kind of candle when I would start to look for lower support levels. So until we get that, I would still just remain bullish and assume we're going to ride the 20-day higher. But if we lose that 20-day, that's when I think you have to at least consider looking at the possibilities of a further decline. Semiconductors, gambling. Let's look at those two, and then maybe throw in home builders. We'll wrap up with that one. Semiconductors moving up, but recently you can see the breakout was at about, 73, 75. Notice the pullback here, just below 7,400. We've had a lot of recent lows, 7,400, 50-day moving average, 73, 72. I think it's pretty clear we're near key support on semiconductors. Gambling and home builders. Gambling, you can see a nice little cup back up near the right side of the cup. Don't be surprised we get a little bit of a handle. Maybe we go right through. But if we do get a handle down to the 20-day, in my opinion, that would be a very interesting time to enter on the long side. And then you've got home construction. Home construction, certainly expecting lower interest rates. That's one reason why you would move into these stocks. I don't know why we would be seeing this if the market's looking ahead and seeing higher interest rates. This wouldn't make sense. So it's another reason why personally I would be more bullish as we head toward the end of April and into the month of May. Upcoming earnings. What I wanted to do on the earnings is just remind everybody that if you are an Earnings Beats Digest subscriber, you can get these earnings chart lists. So we provide these earnings chart lists to our free community. And what we do is we organize these chart lists so that every earnings report from yesterday after the close and today before the open is on one chart list. So the ones that reported after the bell yesterday are started with 0001, and they're in number number order based on market cap. So it's based on the size of the company. Then if they reported this morning, they start with 1001. And again, listed in order of market cap. The beauty here is that as soon as the market opens, you can hit the refresh and it will give you what all these companies are doing at the opening bell. You can sort it by sector. So you can see what the communication services. Remember, I just said internet stocks have been strong. Well, here's an internet stock, Spotify, that reported. What's going on with the stock? Well, we're going to find out at the open and throughout the day. It's a great way to keep track. So we can sort it the way we had it in number order, which gives you market cap order, or by sector, or by industry group, or we can do it by scooter. See if the top scooter names are the ones that are reporting best results or best reactions, getting the best reactions. Or just sort on percentage change. And let's see, after the market opens, which one's getting the best reaction, which stocks are getting the worst reaction. All of them on one chart list. If you like to follow earnings, why wouldn't you want them organized? I mean, if we pull up the edit function here, you can see there are 95 charts. I mean, you can go through each one of them 95 or one at a time, looking at 95 charts if you want, or you can just have it already put together on a chart list for you. All right. It is time to wrap up. So I'm just going to go ahead and call it a day here. I think we've looked at enough of these charts for one morning. But I do want to thank everybody for tuning in. We'll be back. I'll be back later today on the final bar. I'm guest hosting the final bar. And while Dave Keller goes off to New York for the CMT symposium. So I'll be there guest hosting the final bar at 4:00 on StockCharts TV for the next 3 days, today through Thursday. Got some great guests coming up, so you don't want to miss those shows. At Earnings Beats, you can listen to us on our live YouTube stream. Again, that link will be in our chart of the day that we send out, our Earnings Beats Digest. Make sure you sign up there. Everybody have a great day. Happy trading.